I'm Rob Atkinson, President of ITIF. I want to welcome you to an event this morning where we're really pleased and honored to have two really leading thinkers in the U.S. on competitiveness policy and business strategy and government strategy from McKinsey Global Institute, who I'll introduce in just a second. So what we'll do is we'll hear from Lenny and then Jana, who will present the results of a new study that they've done looking around the world at why a sector-based approach to economic policy should be a key ingredient of any national strategy to grow the economy. And then I'll make just 5 or 7 minutes of comments, and then we'll open it up for discussion from you all. I think this is such a key issue because, as they will show, the performance of any national economy is really, it's sort of obvious. It's like I couldn't even have to say this, but it needs saying because it's not recognized in Washington, which is the performance of any national economy or state economy or any economy that you can find in any certain way is fundamentally made up of the performance of subunits, and the best way to think about subunits are individual sectors, and the performance of them varies dramatically within any particular economy. And yet the overall sort of view of economists is you really only need to worry about these macro factors. These micro level or sector level factors really you don't really understand them, they're not that important. And that's why when we saw McKinsey Global Institute work recently, I think it was a study released in March, which they will talk about with such really, really excellent work. And I've long been a fan of McKinsey Global Institute and Lenny and their work. I think they have some of the best insight really anywhere in the world on how you understand what's going on in the economy. So we're really pleased that we'll get to hear that today. So let me start with Lenny. Lenny Mendoza is Director of Knowledge Development at McKinsey Global Institute. For those of you who don't know, McKinsey is set up. They have McKinsey Consulting, which is I guess that's where the money comes in, and then you spend it all. And they have McKinsey Global Institute, which is sort of the internal thought leadership or think tank arm of McKinsey, where they really try to develop knowledge that can help not just McKinsey consultants, but really everybody who is interested in these things. So Lenny is director, senior partner in the San Francisco office of McKinsey & Company. He's also on the Shareholders Council of McKinsey, the board of directors, oversees the McKinsey Global Institute and the McKinsey Quarterly. He's led several of McKinsey's research efforts. He's written and spoken extensively on issues around globalization, economic development, education, energy, healthcare, financial services, corporate strategy, you name it. Lenny's really been deeply involved in it. He's also Chair Emeritus of the Bay Area Council. He's on the board of New America, Common Cause, the Bay Area Science and Innovation Consortium, and a number of other organizations. He has his MBA and certificate in public management from Stanford Graduate School of Business, and holds an A.B. magna cum laude in economics from Harvard. I did not know that. I am now going to buy Half Moon Bay Brewing beer. He's the founder and owner of Half Moon Bay Brewing. I didn't know that. So obviously there's much more to this than simply just that's what I'm Jana Ramus is a senior fellow at McKinsey Global Institute. Since 2003, she has led McKinsey's research on productivity and competitiveness. I also should have mentioned, McKinsey, in my view, does probably the best work on productivity. To understand productivity, you have to understand sectors and technologies. It's just as simple as it gets. And one of the great things about McKinsey's work is to actually look at individual sectors, how they're changing, and how productivity is performing in these. She's been involved in over 15 country performance assessments around the globe, including on productivity and skills and cost, how they influence sector-based competitiveness. She also leads MGI research on energy markets and has been looking at the process of global industry restructuring around various countries. Prior to joining McKinsey in '96, Jana was a research fellow at at various international development agencies and universities, and has a PhD in applied economics from Stanford and a master's degree in economics and philosophy from University of Helsinki, and I think she's a part owner of Budweiser.
Thanks, Robin. It's a pleasure to be here. I have been a big fan of what ITIF has been doing, particularly in ensuring that the innovation and competitiveness agenda is actually informed by something like facts, and that we try and get that on the agenda of policymakers in this country. And I applaud you for continuing to be championing that, and welcome the chance to engage in a conversation with you today. So thanks for inviting me. So let me start with a little bit of background on the research that we did, and then I will turn it over to Jana to help take us through the specifics of it. This work was based on a year-long research project at the McKinsey Global Institute, which, as Rob said, is our economics and business research arm. We attempt to combine the rigor of academic economics with our own global industry expertise based on our client work to help shed light on the microeconomic underpinnings of macroeconomic issues. And within our broader research agenda, as Rob mentioned, we've had a long history of looking at how industry-level productivity performance translates into overall country and economic growth. We've been at this since 1990 and looked at more than 20 countries and 30 sectors in great detail, much of that led by Jana. The purpose of this research, as with all of MGI's research, is to help provide a fact base that helps global public, private, and social sector leaders in their decision-making. The partners of McKinsey fund MGI's research in full. We don't receive funding from any external public or private sector institution. It's all funded by the grace of our partners. Our research on competitiveness and growth looks at the role that policy and other government actions can have on growth. This is obviously an issue that's in the headlines today as we come through this, hopefully, the Great Recession. Governments are obviously feeling the pressure here and elsewhere to do something that can help boost competitiveness and growth, and do that within the constraints of increasingly difficult fiscal and monetary challenges. But the track record, if you look back at the past, is decidedly mixed, and the coffers that public sector has today really makes it difficult to spend money on anything. And so what is it that governments can do? And so to look at this questions, we took MGI's usual sector-based approach. We looked first at what matters for performance in different sectors, and then we looked at what policies have been successful or not at generating growth in those sectors around the world. Two types of insights emerged from this work. First, we discovered some interesting patterns in growth in different sectors. And then secondly, we have some thoughts on some very tangible lessons on policy, and we'll talk through each of those. We'll take about 15, 20 minutes or so to talk through the findings, and then open it up for discussion. So let me start with the first one on sector approach and why it matters. It's a complicated chart. It's in the material that if you want to read it in more detail, you can't see all the colors that we handed out in the back. Sectors are obviously very different in their underlying economic and industry dynamics, and policies that are effective given those dynamics are going to have to vary as well. As we looked at this, we identified 6 primary sector groups that share characteristics and respond to similar approaches to enhancing competitiveness. And we did this at looking on the horizontal axis at how tradable a sector is, and how differentiated the sector is in terms of its products or brand, which is the vertical axis. And that's, is it a commodity product largely competing on price, or is it a product or service that competes on performance and quality? So again, the horizontal axis at a simple mathematical level is imports plus exports divided by gross output, and the horizontal or the vertical axis is a scaled measure of differentiation based on elements of R&D and marketing spend. So the 6 sector groups we looked at are are listed here. The first one is infrastructure services, the dark blue. The second one is local services, which is the lighter blue just above that. The third one is business services above that, the lighter blue. The fourth one is R&D, intensive industries, which is the orange and yellow one to the right, the darker orange one. The fifth one is traditional manufacturing, which is the lower right-hand box. And then the sixth one is resource-intensive industries. I mixed them up. Resource-intensive is the one before, and R&D-intensive is the one on the upper right. Infrastructure services like telecom have large fixed network costs that create large economies of scale and often have monopoly-like economics. And at the other end of the spectrum, the R&D-intensive manufacturing sectors like semiconductors have a very rapid pace of technological innovation, and differences in product performance matter a big deal. And companies on that sector obviously need to continuously keep up with the pace of innovation. And in between those extremes, growth and competitiveness on the range of manufacturing sectors depend on the value that's received for price. And governments need to look and address growth and competitiveness of these sectors, we think, at a much more granular level. Auto, for example, the roles of technical expertise, logistics, and labor costs vary depending on whether you're talking about making tires, complex electronic components, or the final assembly of cars, and thinking at a more granular level about what that implies for government policy is an important part of what we'll want to talk about today. So with that, let me turn it over to Jana, who will talk to us about the patterns of growth that happened and some of the policy lessons that come from looking at this sort of granular level of growth and competitiveness. Yeah.
So as Lenny mentioned, there were two kinds of findings that came from research. First, there are some patterns when you start decomposing the aggregate growth into the different sector contributions. And we chose three of those patterns, if you want, that are particularly relevant for many of the debates today. First, success in emerging innovative sectors is not enough to sustain growth. There's been great expectations put on semiconductors in the 70s and 80s, on biotech and nanotech after that, and right now clean tech in terms of job and GDP growth generators. However, when you actually look at the data behind those sectors, it is a relatively small group of activities that are occurring. In the US, where actually these are quite well-developed sectors, each one of the new emerging sectors has an employment level that is less than 1% of the overall employment. This doesn't mean that we don't think these sectors are important. They obviously are, and their capacity to boost productivity amongst their users, for example, is very large, as happened with semiconductors and PCs as their performance increased and their cost went down. It just means that in terms of near-term job creations, having great expectations are unlikely to be met in reality. The second one of the findings is that the mix of sectors matters less for the overall performance and growth than how those sectors actually perform. Those countries that grow faster than their peers don't do so because they have a more favorable sector mix that propels them to growth. It's simply because their sectors outperform their peers. The way we assessed the impact of sector mix was that we took a sample of countries at similar stages of economic development and looked at their sector breakdown. We then generated a growth momentum, the middle column on the chart, that basically is the predicted rate of growth in the country if each one of its sectors at their share would grow at the average rate of that sector growth amongst its peers. And when you look at that middle predicted growth rate, it actually varies very little. Take the United States and Germany. Despite their quite different shares of manufacturing, both of them have a growth momentum or predicted growth rate of 2.3%. What really matters for the actual growth rate is how their sectors relatively perform. That really is where you can see large differences between sectors. Exactly the same thing holds true even if you're looking at middle-income economies. And the intuition behind that is that at certain stages of economic development, at certain income levels, countries actually vary surprisingly little in the shares of the sectors. So the capacity of those small differences in the sector sizes to predict or influence largely the overall growth is limited. Third lesson, service sector growth is critical, particularly so if you are interested in jobs. We all know that more than 2/3 and up to almost 90% of certain economies amongst the high-income segment come from services. But when you look at growth and job growth in particular, those figures become even more striking. Since 1985, over 20 years, of the overall GDP growth amongst all high-income economies, almost 90% of that GDP growth came from services. And when you look at the growths of these countries in these samples, the countries that lacked their peers, they lacked because their service sectors didn't keep up. And of course, many of you know that in the US, one of the biggest productivity miracles that happened in the late 1990s, when basically US productivity accelerated and ended the catching up that Europe had had to US that had occurred for decades before, that was due more than 50% to the acceleration of retail and wholesale alone. So services matter a great deal for growth and differentiating between your peers, and it's even more important if you look at jobs. Of the overall net new job creation, so expansion in the employment pool amongst high-income countries, very much more than 100% of the net job growth has come from services, who have in essence compensated for the decline in industrial goods-producing sectors. Even the most high-powered industrial high-income countries, if you want, South Korea and Finland, they have at best been able to keep their manufacturing job employment flat by replacing lost jobs with new ones. But there really are no exceptions to this rule. In a way, job growth has come up to a certain income level after industrial growth has peaked. They have come from services. And it's actually surprising, even amongst the middle-income countries, that includes Latin America, good chunks of Asia, 90% of job growth comes from services. So these are just a few examples of the kinds of insights you learn when you look at how the overall aggregate growth has come from different kinds of sector contributions. And these are useful largely for being realistic about what kind of expectations you have for sector contributions. Knowing what has happened in the past, and some of these patterns are extremely consistent. In economics, you seldom see as consistent patterns as some of the sector contribution patterns that we see. And the kinds of conclusions you can draw them for today's policymaking is, for example, in the question of clean tech. From purely job creation perspective, we might be much better off and likely to find more jobs if we were looking at low-tech, clean tech jobs in improving insulation of houses, upgrading heating and cooling equipment into more efficient ones, etc. But in addition to these patterns, we also learn some quite tangible lessons of what kinds of policies tend to work or not in what kind of environments. And these kinds of findings we drew from very in-depth sector case studies. We chose one sector in each one of the sector groups that Eddie just explained and looked at how countries have performed in those sectors, what policies they had in place, and how those policies help explain or not the outcomes. So we've actually dug very, very deep to see what was going on. And in each one of the sectors, we used a consistent policy framework to understand what exactly was the policy or government actions in place. And this is the description of the framework. We took the potential policies and actions and aligned them according to how interventionist they are, if you want. Starting from the left-hand side, government can choose simply to set the ground rules of what kind of labor and capital market regulation you have, perhaps have general business environment conditions as well as some national priorities or roadmaps. Second, governments can build enablers or support private sector activities without actually intervening with the market mechanism. And here, with this we mean all kinds of soft and hard infrastructure, education and training that expand the pool of skilled workers, or different kinds of support for R&D activities. Third, governments can choose to tilt the playing field or create a favorable environment for local production for goods and services. And this is traditionally has been done largely through trade policy, protecting the local industry through tariff or border trade policies, but also increasingly by providing different kinds of incentives for local production. In some cases, government purchasing or regulation of the local demand can also act as a kind of favorable environment for local production. And on the interventionist extreme of the spectrum, governments can choose to either subsidize certain companies, own state-owned enterprises, restructure certain industries, or provide some kind of funding, particularly for ongoing operations to keep them afloat. And when we looked at the 6 sector case studies and looked at what kind of policies had been in place and looked how the sectors had performed, that's how we draw the conclusions. And overall, just to give you a very quick overview of the quite granular information we have by sector, we actually found, and a big finding for us was that regulation matters hugely for all kinds of sectors. In a way, it does make a difference, but it makes a difference in a very different way, depending on what sector we are talking about. So what this chart attempts to do is to synthesize up from our sector cases on what kind of policies were in place in countries and sectors that tended to perform stronger than their peers in a way. What kind of policies were associated with faster growth? It doesn't mean that in all cases, but and you will get the flavor for what we mean with that. But starting with the local sectors, local services like retail, infrastructure services like wireless telecommunications. Here, because these are local and there's limited trade, governments can pretty much set the rules of the game and determine the outcome of these sectors. In wireless telecommunications, governments can allocate spectrum, they can set the regulation that, in essence, set the incentives for companies on how to behave. And the challenge really is to get the balance right between getting scale from those large networks and at the same time creating competition that creates incentives for companies to offer better, cheaper services to their customers. And it's this balance that it's hard to get right, and that's the challenge really for the policymaker. And it can go wrong because a monopoly has high prices and doesn't get the kind of market growth in some sectors, or it can go wrong because you are pushing for too much regulation, too much competition, and you fragment the industry. That, in a way, we may argue that early stages of U.S. wireless sector, this was the case. We had over 50 local wireless players because the spectrum was allocated for relatively small regions. On the case of local services like retail, regulation matters, but in a very different way. These are industries where you have small players. Getting an intense competitive intensity is important, and that is the one that creates incentives for players to adopt best practices, to innovate, and most importantly, pass the benefits of those productivity growth actions to their customers. And it's actually regulation that largely explains how these sectors play out. What we have in this chart is, amongst the high-income economies, the labor productivity of the retail sector on the horizontal axis, and the employment level of how large pool of employment there are in the sector. And there's wide variance in the performance between the sectors, but that variance is by no means random. It quite closely correlates with the regulatory environment. Countries that have land markets and product market regulations that allow entry of new players and creates competition tend to have higher labor productivity. So for example, Japan, that lacks many of its peers, lacks so because there is explicit restrictions for large format retailers to come in and strong incentives for small-scale mom-and-pop stores to stay in business. On the employment axis, in turn, countries that have flexible labor market, particularly timing of work, part-time work, etc., as well as low minimum wage, tend to have higher employment. And we have studied many of these cases in quite a bit of detail, and it's fascinating to see that when you see changes in one of the policies, you see the performance move in a similar manner. Sweden, for example, in 1995 was lagging the US significantly in labor productivity. They explicitly designed policies of opening up retail for foreign investors, changing land policies and zoning laws so that you actually facilitated the entry of new players, and they actually aggressively went after some local monopolies by saying you need to open space for new retailers. And retail sector productivity there grew at twice the rate of its peers, by 4.6% over a 10-year period, which is a very large boost to productivity growth. So this was an example of the local services. Let me talk about the skill-intensive sectors, business services and R&D intensive manufacturing. Software was our case study for business services, and it's a sector where setting the ground rules and direction was not necessarily sufficient. In a way, this is a sector where having skilled workers was critical. And for that reason, particularly the talent question, education, training was very important. The 3 countries that have been exceptionally successful in export of software services, Ireland, Israel, and India, all had a large pool of talented software engineers at a totally competitive cost. In addition to that, there have been some cases in which local demand, either from the private sector or public sector, has been a real customer pull for the sector growth. On the other hand, financial incentives, which some locations have given for software services, we didn't find those to be particularly important, and in some cases we found them to be completely unnecessary. Taking then the other, if you want, high-skill sector, we looked at the R&D intensive manufacturing of software. That was our case study, and here, while it is similarly fast-moving, innovative sector as software, it's also very capital-intensive, so the dynamics are very different.
Semiconductors.
What did I say?
Software.
I'm sorry, I meant to say something, semiconductors, thank you, Lenny. And in the case of semiconductors, actually, of all the locations where we have a successful global semiconductor industry today, every single one of them had government proactively support the sector in at least the tilting the playing field form. In the US, that came in the form of defense and aerospace contracts. Fairchild Semiconductor, Intel's predecessor, they received 80% of their revenues from government contracts, either directly or indirectly, in the late 1950s. In South Korea, it came through subsidized funding for investments, and in the case of TSMC of Taiwan, one of the most successful and profitable semiconductor companies today, their origin was in a publicly funded research institution that spun out different businesses. TSMC was one of them. There were many others. Why they were so successful was really a factor of the fact that they had a very strong business case. They innovated in bringing in the foundry model for semiconductor industry, where they produced other people's designs in chips. And also, and at least as importantly, was the fact that they had excellent execution. They had a team of experienced semiconductor managers, global leaders in their field, who were brought in to execute that. So this is just an example of the semiconductor companies that are successful today. All of them received public funding. However, receiving public funding is not sufficient to make you globally competitive in these sectors. In the last 20 years, there's been no other country that has been able to catch up, and it hasn't been because of lack of trying. We have mentioned here for Singapore, Germany, China, Shanghai, Malaysia, all of them have tried to establish local semiconductor industries, and the subsidies they have received, the public support for these efforts have been in the billions. Yet not one of them has really created a sustainable growth industry in semiconductors. So that just tells about the challenge in these competitive global industries. Governments have played a role in supporting their growth, but that by no means is a guarantee of success. And just last, let me touch very quickly on the resource-intensive industries and manufacturing. These are sectors where the broadest set of policy tools have been used to promote competitiveness and growth. And it's also the one where those tools have had perhaps the largest variance in their outcome, depending on whether they were targeting activities that had a real business case for local production and how those efforts were executed. So in a way, in these sectors, there have been successful examples of governments who have promoted a sector growth that has a very strong business case and a very much a private sector mindset in the execution of those. But perhaps one thing to take away from that, given that the story is quite fragmented with examples, is that because of the efforts of trade barriers to protect the local production, as well as the subsidies have been very large, reaching $100,000 per assembly job, for example. That's by no means uncommon. Multiples of that have been seen. Because of all of that public support, the industry globally is fundamentally shaped by policies, by the trade barriers where you can trade, where you can't, by the subsidies, etc. So it's hard to talk about the global market for automotive as much as the government plays a fundamental role and has led to increasing capacity, overcapacity today, and different cost bases. And similar story for resource-intensive industries like steel, where you see a very different curve, if you want, over time taking off. Governments are closely involved, often funding and creating steel industry at the time when it tapers off. Typically, the efforts go into boosting performance and productivity and competitiveness of those sectors. And at the high income level, where steel tends to be a declining sector, governments have typically participated quite actively in finding ways to downsize, restructure, and help find new employment for people who are based on those sectors. So, in conclusion, just a very high-level overview of the kinds of findings we got, both of the patterns that it's good to be aware of in order for us to set realistic expectations for sector contributions to growth. The role of emerging new technologies is limited by their size. Focus on your sectors performing strongly rather than getting the mix of your industries right. And third, make sure that the service sectors that are large and employ a big chunk of your workers hold their share. And then, if you are having growth policies for your sectors, make sure that you target the levers that actually matter for that kind of sector. In domestic sectors, policy makes a big difference, and you can quite directly influence the outcomes. In globally competing sectors, it is harder. It is much more dependent on success on the global marketplace. And whatever you are doing, make sure that the business logic for the government investments is there, and that the execution that will be critical for success in the long term is also present, and you draw on the talent, particularly private sector talent in many cases, to make sure the sectors succeed. So that's at the very high level of the summary of our work. I think we are over our 20-minute point, and we'll look forward to continue the discussion. Thank you.
Go back to one slide here. Just make a couple of remarks and then we'll open it up. When I look around the world at where countries are and you talk to them about what their strategies are, almost all of them are, they're sort of here, but they really want to be here. So they spend 90% of their efforts in this little space up here and almost nothing over here. And this isn't just the failure of the Chinese government. China's right here, India's right here. India's actually over here too. It's the failure of the World Bank. Talked to a lot of the World Bank people. That's what they think their job is, to help countries. And I think in some ways, to me, the biggest impact or takeaway I would have, or really two from the McKinsey work, one is that most countries just fundamentally have the wrong strategy. They're putting all their eggs in this very small basket. This is China. It's just, indigenous innovation in China. It's just get as much of that stuff as possible. You go to China, and their productivity in this kind of stuff is so low. I was over in India 2 years ago, and I used this great McKinsey quote, statistic that retail productivity in India is 6% of U.S. retail productivity. In other words, for every $100 of output that the U.S. gets, we do it with 6 workers, they'll do it with 100 workers. And yet, India doesn't really care about retail productivity. They actually passed a law that let Walmart come into the country, but only if it was owned, majority owned by an Indian company. And as I understand, I read this, I don't know if it's true, I read it in the paper, that they only let small companies buy from Walmart. So you as a consumer can't go to Walmart, But if you're a small company and you want to get cheap inputs to your business, you can go get your products at Walmart. It's just totally crazy. So I think in one way, that's to me this sort of critical insight of the McKinsey work, is that countries are focusing on the wrong place. The second is that I was just actually talking to Lenny before this. I asked him whether the McKinsey side of the business helps governments. I would venture to say that the top 1,000 global companies all hire consultants. They hire McKinsey, they hire Boston Consulting, they hire various consultants because they know they need help thinking through their strategy. All 50 states, at some level, hire consultants to figure out their economic strategy. And frankly, most countries hire consultants to figure out their economic strategy. We are probably the only country in the world that does not think it's worth our time to hire McKinsey or, I'm not picking McKinsey or Boston Consulting or, if you name it, any consulting firm, to figure out what the strategy should be. Now, why is that? Why are we the only country without a national strategy? I think Ghana recently, Stephen Nizell, Ghana has developed a new national strategy. So here's a country that, what are they doing? And they have a national strategy. I think it really boils down to three things. Why don't we have a national strategy? Why is it based on sectors? One is our politics, both sides of the aisle really fundamentally misread what's going on. Liberals, I would argue, essentially look at this dynamic as saying, we don't really care about this, we don't really understand this, we don't really need to understand it. All we need to know is that there's a flow of money coming out of this, and we're going to take that money and put it somewhere else. That's sort of a sort of upper level. That's more or less what's going on with liberals. Maybe we need to regulate some stuff here to protect workers' side, but it's largely sort of the engine sort of runs by itself. Our job is not to intervene on the engine. Conservatives actually, believe it or not, have more or less the same view. Their view is that this isn't really sort of any kind of national enterprise in a way. It really is. These are just a bunch of individual firms in here that interact in price-mediated market transactions, and the fundamental role of government is just to enable these price-mediated market transactions to occur. There is no proactive role for government at all. When you put those two things together, you have a very small political space for people saying, wait a minute, we think the government needs a strategy. It needs to be thinking through sectors, and it needs to think about those four things, all of those different things. Some, as you say, some parts of it, you don't really want to do that much intervention. Other parts, you may want to do more. And the last part, I think, of the problem, and perhaps the most fundamental problem, is that neoclassical economists really would look at this chart and they'd go, where are interest rates? That's really what matters. Where are prices? In other words, the vast majority of neoclassical economists who advise policymakers in Washington simply don't understand sectors, nor do they think about them. And I think it's interesting that Lenny you both have business degrees. And it's not a coincidence. People from business schools actually think about business. That's what economies are made up of. They're made up of organizations, whether they're government organizations, non-profit, or for-profit. So I think fundamentally the economist sector of our economy is really poorly tooled to do this. They really don't have the skill set or the background to think this, and that's why they argue so vociferously against it, because it would require them going back and getting MBAs at Harvard or Stanford. They don't really want to do that. They want to rely on their PhD in economics from Harvard and Stanford. So if we were to do a national strategy, what would it look like? And then I'll close. There actually is some discussion of this. There's a bill in the House that Congressman Rush Holt is either introducing or has introduced, I can't recall. At least he's thinking about this. We've been working with his office on creating an analog to the national broadband strategy. So for some reason it's legitimate for us to spend a fair amount of money, although in McKinsey numbers it's probably not a fair amount of money, but $20 million, a fair chunk of money, on a national broadband strategy. Why can't we do the same thing on a national innovation competitive strategy? So, Mr. Holt, as I said, there's also a bill being written in the Senate to do this as well. And if we were to do a bill like that, what would we look at? How would we do it? I think there's a whole set of things that would be, and Lenny, to me, made the key pointer, there's no money anymore, so how would you do things if you didn't have money? What would you look at? Well, I think the opportunity set is huge. Just think of a couple of examples. The largest buyer of construction services in the world is the federal government through GSA. So they have an enormous amount of influence on what goes on in the construction industry. And I would argue by how they purchase construction services, they could significantly influence the rate and pace and direction of innovation in the construction industry. There's an event we did about a year and a half ago with a guy who wrote a book called Broken Buildings, Busted Budgets, on how totally abysmal our construction industry is in terms of innovation and productivity. Federal purchasing could certainly change that if there was a strategy behind it. Manufacturing. One of the key things we've done, one of the reasons, by the way, why our semiconductor industry is competitive, I don't know if you look at it in your work or not, was a thing called, Semitech for one thing, and also a thing called the Focus Center program, or another word for it is the Microelectronics Advanced Research Corporation. This is a DARPA program where they've created a roadmap on semiconductors with the industry, and they fund advanced research at 6 universities around the country. This, to me, is a key thing, a key factor. We need to understand individual sectors. Retail. One area of retail that's key, and that's regulations imposed by incumbents who don't like e-commerce competition. So we've seen that over and over and over again, and while our retail sector is probably one of the most productive in the world, there are still an enormous number of barriers to innovation in that sector that if the federal government chose to, it could eliminate with the stroke of a pen. Anybody here buy a car online from Ford recently? If you did, you should go to jail because it's against the law. You cannot buy a car online from Ford, not because Ford doesn't want to sell you a car online, but because car dealers have succeeded in passing a law in every state to prohibit you from buying a car online. Now, why would car dealers do such a thing? Contact lenses. For a long time, you didn't have the right to get your prescription from your optometrist. Why would that occur? Could it be that optometrists don't want to see competition? Luckily, we passed a law to change that. The latest one now is pet medication. Turns out pet medication is this unbelievably huge industry. It's a multi-billion-dollar industry, and Walmart and some online pet medication companies want to be able to sell you pet medication for half the price of getting it from your vet. Very hard to do that because vets are able to control medication, and there's no law in some places to enable that. So I think in some ways there's a lot the federal government could do, whether it's direct strategies, whether it's thinking about how to remove these barriers, whether it's how to do procurement. And unless we think about individual sectors, we're not going to get that right. Last thing I'll just say is, I think one of the key things that I look at McKinsey's work is you need two things. You need, on the one hand, you need a market environment that forces companies to innovate. And for example, we don't have that in the automobile dealership space, if you will. They have a monopoly on that. We don't have it in other sectors as much. And so thinking through how do you force companies to need to innovate through competition policies is one key thing. The second thing is they have to be able to do something with that. You can force them to innovate, and if there's nothing they can do to innovate, they're not going to do very well. And that's where I do think it's important. And if I had sort of one suggestion to McKinsey's work, you can respond to this, maybe say I missed it, but I think there is this notion of that there's a set of technology tools that are available, and these technology tools differ as they evolve. And I would argue that IT has been this key technology tool for many of these sector transformations. And government can play a key role in that, much more than I think a lot of free market fundamentalists would believe. We did a study where we looked at health IT leadership around the world, and it simply cannot be, market factors or demand factors like that have the Scandinavian countries at about 4 to 5 times more health IT usage than the U.S. So 80 to 90%, 93% doctors penetration of health IT. In the U.S. it's around 17%. That cannot be just simply that we have some software that isn't as good as theirs, or that this is about a conscious set of policies to drive health IT in those countries. Similar intelligent transportation systems, we're woefully behind there. Japan, Korea, Singapore. These are key technologies that also end up affecting OEMs with the ability of things they put in the cars. Mobile payments. This is kind of a key platform technology. You can do all sorts of things, including transform retail. But if you don't have that ecosystem of the the reader, of the payment system, and of the device all working together, you're not going to get it. We have no mobile payments in the U.S. Japan, Korea, Singapore have large numbers of mobile payments because they've had conscious policy. So I guess in addition to sector policies, I would argue that there's sort of these platform technology policies that one has to also get right. In some cases, that means relying on the market. In some cases, it means thinking about how regulation affects it. In some cases, procurement. So with that, let me just, maybe Lenny or Jana, if you want to respond to any of that, or else we'll just open it up to comments, questions.
Let me just make one comment on your observation around platforms. 100% agree. And in fact, in part of what we were talking about in terms of enablers are hard and soft infrastructure, including information technology that can enable both the development of innovation and the diffusion of innovation. And if you look at some of the sectors in the United States that are much less competitive globally or have a major opportunity for innovation, healthcare, education, the public sector more generally, those are three of the least penetrated sectors in terms of underpinning information technology. And some of the rules of the game don't create the competitive intensity and the focus on cost-effective innovation and scaling that innovation that would enable the kind of productivity improvement that would be necessary to be competitive in the sector. So 100% agree.
Even actually some of the ones that are traded, if you will, we did a little sort of mini study on the hospitality industry and technology use, and it turns out that at least one country, Finland, Stephen, is it Finland or Sweden? Finland, as part of their national technology, they actually had a services innovation strategy, which actually my colleague Stephen Azell helped advise on. And one of the things they actually funded was a brand new model of hotels where you go online to this hotel and you check in, you get your key code. It's a little key code that's SMS to you, and you go into the hotel. There's nobody at the front desk. It's a totally 100% automated hotel. You just go right up to your room, put your thing in, and you check out online. And if you need somebody, you can call somebody, and they come from someplace else. But it's sort of this really kind of cool idea: totally automated hotel, high value, low price. So there's some interesting innovations in other sectors that you would think we would see more of, but we don't. So let me open it up to comments if you can identify yourself and wait for the mic, if you would. Yes, sir.
Hi, thank you very much. Kevin Murphy, president of J.E. Austin and Associates. We introduced cluster competitiveness and sector competitiveness projects to the U.S. Foreign Assistance Program, and they've been done in probably 30 or 35 countries around the world. And Harvard MBA, so I understand. I appreciate, also did a lot of economics up there, so I appreciate your focus. A few questions. It seems like the U.S. needs a crisis to focus on competitiveness. And the last time we had a crisis in the late 70s and early 80s, Japan is number one, etc. The debate kind of came out this way, that our political, it would be great to do that, and Japan's doing it, yes, other countries are doing it, but our political system is such that once we decide we're going to really assist some of these key growth sectors, these resources, given the Hill, will become captive of those industries that have large vested interests and unions and political clout. So the money will be channeled not in the effective ways. So it's very hard for us to do industrial policy or competitiveness policy. The second thing is, we had a competitiveness council, competitiveness policy council for about 7 or 8 years. We declared victory in about 1997 or 98 and went home. Maybe it's time for a new one, but there is a council on competitiveness, and it'd be interesting to get your thoughts on what they're doing, and also whether you agree with the competitiveness index of the World Economic Forum that also use the word enablers as you do, and is your sense that indeed as countries grow from low income to middle income to high income, that there needs to be a shift in policy, and what are your, do you agree with sort of it's also controversial in a lot of places, and I know the Council on Competitiveness doesn't really like that index that well, but it would be really interesting based on your fact-based, evidence-based research, what you think about that, and whether that's a good way to think about it. Also, I know your focus has been on the U.S. and developed countries, but we focus on agriculture, on helping countries get into the apparel and go up the rungs of the manufacturing industries, and I take your point on the service industry. In these countries, there's just a lot of stupid regulations that keep anybody from doing anything useful and productive. But so maybe there needs to be kind of differentiated policies for different levels of economic development. And finally, do you see any trends in the global economy in the post-crisis environment that change the horizon on which we're going to be competing in the future? And maybe the things that were successful over the last 20 or 30 years may no longer be successful in the next 20 or 30 years. Are there changes that you see happening in that regard? Thank you.
So just quickly on your first point on industrial policy, we are not saying that governments should do this in a way. Our effort, these are in many cases where do you put your money is a political decision. Our purpose is to provide a fact base that we want to show of those countries that grew, what kinds of policies were in place or were not in place. So in a way, we are not advocating doing a specific thing on a specific sector. That's just, we didn't do a full welfare analysis of money spent here versus someplace else. Those are much harder questions than knowing what policies actually were successful in promoting growth. Then if I may take another one on the emerging markets, I think your point is excellent in that there are large differences depending on what stage of economic development you are. In the middle income range, services represent roughly 54% of overall growth contribution, 45% come from manufacturing, and we didn't see any examples of countries where goods producing sectors or industries didn't contribute to growth. So in that sense, for that income group specifically, it does matter, and it brings a lot of benefits in terms of just management skills, etc., that might not be available through without the industrial sector basically one. You want to? Okay, yes, I can. Absolutely. Obviously we know them well. We use them, I would say we use them as a fact base. In many emerging markets in particular, you don't have oftentimes a full data set as we have in the US. We use it as a starting point. I mean, interesting to see. We know there is a quality of specific variables varies widely by countries, but oftentimes it's quite indicative. For example, we looked at Brazil and used them as a starting point. We could see that a lot of the variables indicating business performance were actually quite strong. Brazil has very strong performing businesses in a number of sectors. Some of the banks have global productivity. They are very efficient as a result of hyperinflation, while some of the public sector variables were different. And in some countries, you see the balance being in a different way. We see it as a very useful starting point. And in some cases, those variables are ones that are real barriers across many sectors. But it doesn't mean that solving only those variables will necessarily get you unless you address many of the sectoral examples, which I think we just heard some excellent examples for the US as well.
So, I'll give you a couple other thoughts on the other comments. I do think this crisis will force a re-examination of not just the current horizon about what we do about it, but we are transitioning into an era in which in most of the developed world, it is true in continental Europe already, it's true in Japan already, it will be true in the United States, that all of the growth in GDP per capita is going to have to come from productivity improvement, not increasing the labor force. And so a real focus on what do we really need to do at a very fundamental level to ensure that all of our sectors are as productive as they can be is going to be an essential element of what we're the national attention is going to have to be around. And that is a delicate task because, as you say, the political process makes that difficult for some of those questions to be addressed in a complete way because much of the drivers of productivity has to do with competition. And when you have regulatory environments that are set up to be, in many cases, not set up, but in fact become captured, they discourage competition when in fact we need competition. And so thinking about how we have a real honest discussion about where are the productivity improvement opportunities and how do we go about that is important. I think some of that can and should be addressed by a national competitiveness and innovation strategy. The sets of things working their way through the legislation could be an element of that, but it can't be left to the government alone. This is an important element where understanding the concrete elements of what's necessary are going to have to be informed by the private sector as well, done in the public interest, not in the narrow special interest to get that to happen. And that's a complicated process. The last thing I'd say is part of the last time that there was a major push on U.S. competitiveness was under the assumption that the U.S. was getting it's clock cleaned by Germany and Japan. And in fact, it was in some sectors when a lot of the attention was on traded manufacturing sectors, and particularly the notion of some of the industrial policy at that time that was going on in Japan and Germany. But in fact, when you look one level down, that was a small portion of both of those economies. And Japan operated in a dual economy with a small sector that was globally competitive and very productive, and still an incredibly unproductive service sector. And the U.S., as Jana said, overcame that, not necessarily because of the competitiveness strategy, but because our retail and wholesale sectors drove a productivity revolution in the 1990s. Well, we're going to need another set of breakthroughs around some of those sectors, and not just those, but broader sectors that employ large portions of the economy. And those are much more complicated elements. They do involve the combination of investment in enablers like information technology. They do require much more complicated and sophisticated regulatory discussion because many of the sectors are deeply embedded in policy choices. And it's going to require some public-private discussion about how we actually make that happen. So it's an important topic, and we don't have the answer. We're trying to put forward the notion that these are essential to the U.S. competitiveness and job growth going forward.
Joel, but before I do that, I have two quick responses. One on World Economic Forum. We do a study, did a study called the Atlantic Century, where we benchmarked the U.S. on 16 different indicators against 39 other nations around the world, and some of the same indicators we use, WEF uses, and they come up with fairly significant different findings of ranking of countries. The U.S. tends to perform much better in WEF than they do in our findings, and there's a really sort of fundamental reason for it is that we use a thing called data, and they use a thing called opinions. And when you look at, I'm not making this up, their R&D numbers and their venture capital numbers are opinion surveys. They just ask people who's got the most R&D and venture capital. If you ask people, it's the U.S. It's sort of like looking at a star that's already blown up and you don't see that it's blown up. You're seeing images from the past, and I'm happy to believe that in the past we had the most. But when you actually look at data, it becomes a much more troubling picture. We're not number one anymore on our metric. We're number 6, and we were 40th out of 40 countries in terms of progress in this decade. Your last point about, I just think it's frankly a red herring, your point about that if we do a strategy, it'll be captured by the vested interest and distort money. I actually think that's what's already going on. That's what you get without a strategy. So what is our industrial policy? It's oil, agriculture, and housing.
And defense.
Well, defense is, I wouldn't call it, but that's sort of, we do defense because of that. But sort of the stuff that's a government thing, but these other 3 things are not government things, and they capture a large share of money. And why do they do that? Because there's nobody pushing back saying $20 billion of ag subsidies is $20 billion of waste, and billions and billions of dollars going to the oil and gas industry and tax subsidies is billions and billions of waste. And there's nobody pushing back on that. And when we have had a strategy, if you look at what the strategy has done, whether it was Carter's Domestic Policy Review in '78, or whether it was Reagan's Council on Competitiveness, or a set of other things, the Omnibus Trade and Competitiveness Act of '88, they all have focused not on sort of protecting big incumbents with political power, they've all focused on innovation. SBIR, Stevenson-Weidler, a whole set of things like that, NIST, NSF expansion, BIDOL. I mean, so the fact when we do have a strategy, the historical record is it's not captured by the incumbent. It's only when we don't have a strategy that our politics moves in that direction. Joel?
Yeah, Joel Yudkin, High Road Strategies in Arlington. First, I would say I do very much appreciate the sectoral approach, and I've been pleased that Rob, that you're trying to introduce this to this community out here. The traditional economic theory and models just seem to fail on being able to address a number of important policy areas because they really don't adequately deal with sectors, namely trade, technology, and energy today. I think are all areas that. So I appreciate that. I have a lot of questions, but I'll just stay focused on one slightly more technical one, which is whether you're trying to take a stab at the dynamics between sectors, and that's an area. I know it's tough because this has been the classic problem between micro and macroeconomics. If you're up at the macro level, you're showing a lot of big relationships, though it's not really dynamical. and across the board, across sectors. And when you're at the micro level, you tend to get lost in the silos. But yet, I think the real action is between those sectors. I'm thinking that to what extent do you have to have a vibrant manufacturing sector to actually generate at least a certain amount of growth in the service sector, or internationally though, at the same time you have the thing that a lot of what's driving our retail and wholesale sector in the United States is in fact production going off that is offshore at a very low cost and then being imported here, and those dynamics are also an important factor, and trying to untangle that I think is very important because it's going to vary. And I just wanted to get more of a handle. I'm trying to struggle with that myself.
Absolutely, and by no means do we mean that those connections are not important. It was an explicit choice for us to take a sector focus so we can actually have a specific question and an approach and methodology that we're going to use. But we are very much in agreement that those linkages between sectors are very important. Manufacturing creates a lot of good high-quality services. High-quality services matter a great deal for attractiveness of manufacturing. I think that even the local services, for example, retail is a really important catalyst, not only for generating consumer wealth, because it influences the purchasing power of all households in the economy, but it's also very important as a channel for goods passing through to consumers, so in many ways they can have a very big impact on the productivity of their suppliers. So our purpose was not to minimize that in any way. And we did think it through, and in many of our sector cases, our approach is very focused on the value chain segments, because those are changing. I think it's an area where we don't have as much necessarily data as we would like to. We are trying to find ways in which we eke as much information as we can. But we did, in the cases that we looked at, we don't think any of the findings that we have actually would change, even if we introduced some sector dynamics. We have done a lot of analysis of, for example, multipliers, including them, estimating the multiplier effects, adding them into those figures. I mean, 0.3% of employment, even if you add a very high multiplier to that, it won't make it much bigger than 1%. So in a way, it is not because we don't think those factors are important. It was a choice for us to really scope our research here at the sector level. We are actually thinking about ways in which we can get on those in our research that's coming in the future.
Right here.
Ken Jarbo with the Alliance. I want to follow up on that because I had a similar question to what Joel had. Before that, let me make the political comment. I think one of the things you talked about was what happened in the crisis in the past with Japan and Germany. And you're saying that, well, it really wasn't a lot of the issues that we thought it was. I think in many ways, in the last 10, 15 years, that's come back to bite us. Because the argument has been, and this is what happened to the late lamented both OTA and something that I know very well, the Competitive Policy Council, is that people looked at the lost decade in Japan and said, oh, they weren't really a problem. We really didn't need to do any of this stuff. If we just let the market flow, we were fine. We didn't need to do all that competitive stuff we did in the 80s because Japan wasn't the threat we thought it was. So in many ways, we're victims of our own success in that story. So that's the political comment. The technical comment goes back to what you were just saying, because I'm looking at your lesson number 2, and I'm not sure in the context of the answer you just gave, I understand what lesson number 2 is about the individual sectors mattering more than the mix. Is what you're saying because most of the advanced industrial countries have a similar mix already, what's important is that small differential change in each one of these sectors? Or are you saying that the mix doesn't matter whatsoever? So if you can walk me through lesson 2.
Yeah. Let me think about it. Means that whatever share certain sector has in your economy, it's not. Okay, let me try another way of explaining this. The reason why this is particularly interesting for our private sector audience is that for businesses, the answer is radically different. When you look at business performance, the sectors where they are actually drive 2/3 of their growth performance. If you are a company that happens to be on a field that's rapidly growing, your performance is very likely going to be much stronger than somebody whose industry is mature and there's no growth for anyone. So in a way, the inclination of a lot of business audiences is to think about, okay, we just need to kind of have the right portfolio of activities in our economy, and that's going to ensure we grow because we are in the growth segments. For economies, this just doesn't hold true. Even if you look at very micro level sectors, in a way, the fact that you already have a semiconductor industry and that sector might continue to be a very fast-growing productivity sector doesn't mean that that will actually drive your overall performance. Because many of those fast-growing sectors, they're very competitive. The fact that you were successful in the last 5 years may not mean that you will be successful in the following 5 years. Japan's semiconductor industry being a great example. So in a way, and the same thing applies for the other sectors as well. I don't know if this helps explain it. It is more of the momentum of what your activities consist of that doesn't explain your overall performance. It really is the capacity to each sector with their environment to perform strongly.
So, let me add to that a little bit that may shine a little bit more light on that. At the appropriate stage of development, most countries have a pretty similar sectoral mix, but there is wide difference in the sectoral performance that drives the difference in growth. And so that's partly why we're saying you really need to understand at a more specific level, given the situation in the particular country you're in, where is the gap and what can be done about it. And the concern that we have about the US is not that we should be picking sectors. It's more ensuring that the sectors that we are, given the stage of development we are, that are successful. And the concern that at least I have about the US is related to your first part of your comment about that we will be complacent and assume that it's our God-given right to be successful in all of these sectors, when in fact, particularly for things that are harder to get a look at, it's down the road when you see the impact of not having the competitiveness. And so I'm not sure this is going to be driven by the same catalytic event that was Japan and Germany being outpacing us in some elements. It's going to be more that we need to aspire to have a more robust competitiveness in sectors where the degradation of performance may be more of a concern than we're at near-term risk of another country.
Rob, could I just follow up just to make sure I understand? So what you're saying is it isn't whether we have a nanotechnology or a semiconductor technology or a automotive, it's how well each of those sectors does the productivity in those sectors. Thank you, sorry.
Actually, and then
Paul Taylor with Governing. Absent national policy, two questions about the states. How are they doing with such policy, and what ought they do where competitive policy is concerned?
Two thoughts on it. One is if you take this competitiveness down the next level by region or by state, you've got as much difference in performance as you do between countries. And so having this kind of analysis done and thinking at a state and regional level is as important as a national level. Obviously, given the scale of the United States and the difference in our sectoral mix and performance by different parts of the country, it is very important that that be done. In fact, to be honest, more optimistic that we'll have a national competitiveness strategy that's an accumulation of regional and state strategies that may make some more sense despite ourselves, as opposed to having to be more directed. And so it's important. In fact, we would argue if we're going to do, and we think we should, a national competitiveness strategy, it ought to be integrated, but it ought to be done at a sectoral level and at a regional level, perhaps at state, although some places states are artificial boundaries, but then aggregate that back up to here's the national view. Because what you need to do in Detroit is very different than what you need to do in the South. It's different than what you need to do in Silicon Valley. So I do think that regional and state economic and competitiveness approaches are very important. I would say I am still frustrated, despite the NGA's great efforts to try and make sure that doesn't happen, is that states are often ending up trying to compete, I don't have the chart in it, by throwing subsidies and race to the bottom against some sectors that don't matter, and that is actually very unhelpful. In fact, it is one of the things that other countries in the world, including Mexico, have done, is taking that out of the state's hands. You can't do that, because all you're doing is distributing money from the state coffers to the industries and lowering the average performance.
Yes, my name is Steve Johnson. I'm a semi-retired former consultant with, I was graduated from the same school apparently as Lenny. And I have a question. I remember sitting at Stanford Business School, wrestling with the product life cycle and how that affected the way you would analyze firms. And the Boston Consulting Group was big on that. You said nothing about product life cycle analysis, in your presentation. It sounds like behind what you said, there's some sort of a theory of a methodological life cycle, that if people have the right regulatory environment, they can evolve much more quickly within a sector than if they have the wrong regulatory environment. And I was wondering if you could say something about whether the product life cycle is still relevant at all, or whether there's something that supplants the product life cycle that would help enrich the picture that you just painted.
Well, product lifecycle thinking is still relevant at a micro company or industry level about what's the stage of development, what does that imply for the right action as a result of it. I think the analogy may be more powerful than the specific, which is that you have industrial and country sectoral life cycles, that it's really what underpins Jana's point, the lesson number 2, is that countries go through a natural evolution of development that has an implication for what their sectoral mix looks like. And your industrial policy, your competitiveness policy needs to reflect that environment and migrate as the country moves through various stages of development. So in the stage of development that the U.S. has, obviously given that sector mix, if we're really going to be competitive, we have to think pretty hard about the service sector. We have to think pretty hard about some components of advanced R&D sectors, and we have to still think pretty hard about the underlying infrastructure that is beneath those, both physical, hard and soft infrastructure. So I think that it's more the analogy of life cycle that might be useful for at least how we thought about it.
Just a very quick comment on that, and also it's one of the factors why we differentiate the sectors. In steel, it's very different, where basically product life cycle is very long, and in semiconductors, you make your money in the first 3 weeks or three months, and the product is obsolete in 2 years. So.
Mary Jo, and then
I'm Mary Jo Waits with the National Governors Association, and to follow up on the state question, 2 things. States have primarily done cluster-based economic development strategies, which we argued was they were worrying about their productivity and things like that. And however, that was focused on export-oriented areas. And what you're talking about, particularly in the service areas, the retail, healthcare, are really not traded sectors in many states. So that's something that we're going to have to start talking to states about differently. The second thing is, I was just at IEDC, and that's the Economic Development Group, and mentioned your study, and they're all worried about growth. And so I said, well, let's think about where you're going to get your most jobs. Take a look at this McKinsey study. And they all looked at me like, well, we don't have anything to do with service, health, or government productivity. So tell me how we respond to that for the state and regional economic development strategy.
So a couple of thoughts. The first one is you're absolutely right. There is, and Rob said it earlier, we spend way too little time thinking about service sector performance. And there is, within those sectors that are not traded, there is more variance. The more granular you get, the more variance you see. And so, the healthcare data is pretty widely known now about there is no relationship between quantity and value. And so trying to think at a specific level about what are the policies that could help determine that matters. Now, some of those are state and local based policies. So land use is obviously a state and local policy that influences a fair amount what happens in retail productivity, and then that flows back through a large portion of other things. Healthcare is more complicated, obviously, in terms of the specific policies, although there is some element that can be done there. I also do think that it isn't appropriate to say there are large portions of where our job growth can come from, and there's nothing we can do about it. there are things that can be done at the local and state level, and then obviously the accumulation of states together saying, here's what needs to be done, that can make a huge difference. And so it's a little bit of saying what half of which is true is that the largest thing that's going to influence our overall job growth is the national economic performance. But what determines your relative job growth is a large portion to do with the performance at that more specific level. So, you know, it's, I'd keep pushing that.
Yeah. To your last question on how to motivate that discussion, I think one thing that I have found that usually gets people's attention when you look at what some of the countries that we look as examples of who are doing economic development well, what are they doing? And many of them are actually realizing the role of services. Singapore, for example, who have a very explicit strategy, often used as a benchmark for how to organize for economic development that's coordinated. They had an explicit strategy of going from low value-added manufacturing to high value-added manufacturing, and now they are very explicit going to services because they do realize the facts that we're showing. In a way, you do understand that if they're going to continue to grow at their income level, growth will have come from services, and that's a very explicit part of their economic development plan. Another example is Finland, where also there, I think their success of the collaboration between the government, the universities, and the businesses has been in many ways exceptional. And many parts of the organization, exactly as the example we described, they have explicitly made funding innovations in service sectors a priority because they do realize that's the only way to continue to increase GDP per capita. So I think giving examples of how other countries are addressing that is another way to get to the discussion.
One thing to add on that, the Finnish story is that they look at the services verticals in terms of wholesale mutual trade, logistics, KIBS, knowledge, intensive business services. So they are taking a sectoral-based approach to driving innovation in the services sector of their economy in a very strategic way.
One way to think about that also would be to ask a state, would you be better off competitively in terms of attracting knowledge workers and companies and growing them if you had a 10% tax on retail and the money was burned? Because that's really what's at stake, you know. Or, for example, you decide to raise overall government costs by 15%, but leave services exactly where they are. Would that help your competitiveness as a state? Because that's really what's at stake with the inability or unwillingness of states to focus on productivity in these sectors. They're all over here looking at high-tech manufacturing when there's this other part of their economy that is, if not performing well, is essentially an anchor or a real drag on the rest of what they can do. So maybe we have time for one last question. Jeff, here.
Jeff King, News Europe. I don't think we need a microphone in this room.
We do it for people who are watching online.
Oh yes, very good, thanks. We were talking, Lenny and I were talking when we first arrived earlier about the so-called varieties of capitalism debates that go back about 10 years. And because I was struck by this whole report about the sector orientation toward economic competitiveness, and the varieties of capitalism debates emphasize that distinction with respect to the education, training, and human capital dimension of this whole question. That is, the U.S. has a sort of a general skills orientation, if you take the varieties of capitalism analysis at face value, whereas the Europeans and to some extent the Japanese and some Asian countries have a more sort of sector-based approach toward knowledge and skills development. And I guess I wanted to pick up on that with respect to the comment you made late in the presentation when you talked about healthcare as well as education being areas in which there was in effect low levels in the United States of development of productivity growth. And that bears on the question of how you do marketization. And if we go back to the varieties of capitalism debates, one approach to marketization which the Europeans have taken with respect to sort of the strong middle skills, technical skills, vocational education, training skills that mentioned below at the sub-BA level, sub-graduate school level, is they're in effect using sector knowledge itself as the substance of education and training. They're taking sector knowledge and building it into the substance of lesson learning. Whereas in the United States, with No Child Left Behind, and now the crisis with the private sector firms beginning to make inroads in higher education, what we see instead is treating the education sector as a legacy system in which the private sector firms can make raids on the public sector to try and turn public sector education into a profit-making venture within the private sector. So that's a completely different approach to our marketization. And I'm wondering if you see, as you look out over the world, what the long-term trends are. I mean, Finland, for example, and other countries have these fast turnaround rates, and Finland was #1 in the PISA things for the PISA studies for education. But Finland is, like a lot of these other countries, 2/3 low-kids, the majority of the country. So how is it that fast turnaround is strengthened by sector-based skills in the middle level, whereas we have a higher ed and K-12 crisis, which is simply being marketized by private sector firms. How do you see these trends developing in the long term?
So that's a much longer conversation. But what I will say is I would direct you to a different report that we did that looked at the performance of education systems around the world and what are the best performing systems doing. And it's not coincidental that Finland and Singapore are two of the ones that the benchmark as being top performing. The headline of that is, this is one of the sectors where the cost of the U.S. in the near term is enormous. The equivalent of the gap between our educational performance, K-12, and the U.S. from best performing systems, or within the U.S. between systems, is the equivalent of a permanent national recession. Several $100 billion a year of lost economic opportunity because of the underperformance of those systems. And the report that I'm happy to point you to talks about the elements of what's different in those. One of the most important ones has to do with the quality and paying for teachers, as well as a focus on ensuring that we're getting high quality performance at every institution. Some of that has to do with more specific elements of training for what the workforce needs are going forward. I wouldn't go so far as to say it ought to be narrow tracked into specific industries, but clearly the U.S. is dramatically underinvesting in STEM in education as just one simple example. And the notion that we can, with a straight face, say we don't really care whether we have more STEM educated graduates or not is just ridiculous. And so that would be at least a complement list of things that we should pay attention to.
Great. Well, this has been really very, again, really enlightening, and I just, could you guys move to Washington? Not being in Washington, just move here. Spend your days going around the World Bank and EXIM and NEC and NEC and NEC. Would be very well. But anyway, Lenny and Jana, thank you so much for taking time, and we really enjoyed your presentation. Thank you.